just go back to the hedge equity fund, because I want to understand what the value that I guess the original portfolio managers that created the fund were after, and what investors think they're after. Because when I look at what that hedge is doing, I mean, I've done analysis on this, and I'm going to share my screen just quick, because it just recreated it. But it basically turns out that you can replicate the fund by being 40%, 60% in SPY and 40% in cash. That's the yellow line. In fact, it outperforms it, right? And the correlation is astoundingly high. So was there a different attempt to do something very different than 60% equity, 40% cash, and they're hindered by it now because they're so big? Or was it always meant to do this thing in a way that, like, adding options complexity when cash would have done the job?
Yeah, I mean, look, it's a structured product. There's no real discretion or logic other than they buy the 5% out of the money put, and they sell the 20% out of the money put, and they sell the call that makes that caller premium neutral. That is the definition of what they do. They do that every time. So people know this, and so people kind of front run it and kind of take whatever out of it, but at the end of the day, they're long 1x stock against that. It's about a $20 billion fund. And at the end of the day, they're going to lose money on their stock the first 5%, right? And then they're going to be, fine for the next 15%, and then they're going to start losing money again. That's the hedge, and there's no extra premium to the thing. And then for that, they're going to have only the upside up until whatever call they write, right? And so they have, it's a pretty easy break-even graph to draw. I mean, you can approximate it with other strategies, but it's a pretty straightforward strategy. And they've in a slow grinding up market that does very well, and it protects you from catastrophic losses, probably to the downside. And some people prefer that type of exposure, but it's nothing more than just giving yourself access to certain parts of the distribution, as we talked about earlier, and wanting certain types of exposure. It's not long stock, short stock. It is, a funny looking graph that kind of gives you protection in certain windows and not in others. And, historically, that has been, based on history. I bet you the track record, they probably pick those points because it looks good historically, right? But environments change, and you may not want that exposure during this. If this market goes down 5%, every quarter for the next 20 quarters, you're going to perform like stock performed, which is not very well. So it just depends what kind of exposure you want. And broadly, up until relatively recently, you've gotten quick quarterly drawdowns of something big with some big rally back, and then other periods of grinding. So it's protected you in those big drawdowns, and then gotten you right back on track with certain reasonable gains the rest of the way. And people look at that historical performance and they don't understand options, and they say, "Yeah, that's for me," but that's about it. I don't think that you could read way more into it.